European Union finance ministers have given a green light to the European Commission to negotiate tougher savings tax agreements with non-EU countries Switzerland, Liechtenstein, Monaco, Andorra and San Marino. The decision is part of EU moves to clamp down on tax evasion and tax fraud. At their meeting in Brussels, the ministers also pledged to promote good tax practices and tax governance in countries outside the EU. High on the agenda were plans to strengthen rules for taxes on savings income. The plan is to make it possible to tax all kinds of savings income and products that generate interest, as well as make it harder to get around the rules currently in place.
We also had good discussions today on the Savings Tax Directive. Not all Member States were able to agree to these proposals today. We expect that this issue will be on the agenda of the European Council next week.
The ministers also agreed to amend the EU budget for this year with an additional €7.3 billion. Moves toward an EU banking union were on the table too. The ministers discussed new rules aimed at preempting bank crises and dealing with problems like insolvency when they happen. The measures would establish the order in which investors would be obliged to help bail out an institution in trouble. There was broad agreement that depositors with less than €100,000 in savings would not be called on to contribute. More broadly, the rules would require banks and investment firms to draw up recovery plans, laying out the measures they would take to restore their financial health if things turn sour.